Good morning. Welcome to SOXX Insights. Today is Friday, March the 13th. We are pre-market open. Again, another very tough week in a very volatile market. The US-Iran war doesn't seem to be concluding very swiftly, and that have rippled across the financial markets, with oil staying very elevated, yields shooting up higher, and risk assets being under a lot of pressure. If we look at what happened overnight, USO rose by 10% on the day, and at the same time, SPY, ISP, which is the equal weight S&P 500, IWM, all fell around 1.5% to 2%, which is a big daily decline. And we're seeing a stronger dollar, so UUP is up by 0.5%, and higher yields, meaning lower bond prices. So bonds fell by 0.2%, but down much more during the week. Gold, since the beginning of the war, has acted more like risk assets. It traded down 1.9% alongside equities decline, which is a bit surprising given that the popular narrative is that gold is a safe haven. But I think because of the run-up at the beginning of the year and the end of last year, there was a lot of leverage in play, and the overall degrossing impact since the beginning of the war has hit gold quite negatively. IBIT declined as well on the day, but overall crypto has stayed relatively firm over the past 2 weeks, perhaps to a lot of people's surprise. A lot of people thought crypto would roll over with the broader market, but it hasn't, and instead it's made counter-trend rallies. And I think there are two parts to this. So last week we talked about degrossing. So a lot of the shorts coming into the war have also degrossed alongside their long positions, meaning the shorts on software and crypto stocks have been reduced, and that relieved a lot of selling pressure. But secondly, there has been capital control taking place in the Middle East. So a lot of the banks there have frozen large transactions or prevented clients withdrawing large amount of money to prevent a bank run. And in that scenario, actually the original thesis of Bitcoin, which is decentralized money, where you can take with you anywhere without banking and government control, has actually played out. If you have a lot of Bitcoin, for example, which the Middle East is a crypto hub, Binance is based in Dubai, you probably wouldn't want to sell crypto here and bank your money into the TradFi system where there are restrictions. So in that sense, the original thesis for Bitcoin has actually played out in this war, which is pretty interesting. Now, looking at our proprietary macro surface, so we're measuring the market through 3 dimensions: first, risk appetite, then liquidity, and inflation expectations. We're seeing that the risk appetite was reduced substantially yesterday, down 1.65 standard deviations from its average. Liquidity also declined, down by 0.7 Z-score, and inflation expectation has risen. And we measure those things via the market prices. So, for example, inflation expectation comes from how yields and break-evens are moving and the commodities are performing, whereas the risk appetite measure how risk assets have performed in this environment. So these are very objective scores of how things moved relative to the 1-year average, and is not a hunch or a gut feeling just based on what I see. So this is extremely useful day to day to see how the market is actually reacting to the headlines, to the cross-asset moving parts. Now, if we zoom in on the yields first, we are seeing a big uptake in the 2-year, 10-year, and the 30-year yield. So across the curve since the beginning of the war. So the 2-year has ticked up because now the market prices a lower chance of rate cuts given the high oil prices and therefore high inflation concerns. And the longer end yields have also picked up apart from the inflation concerns because of a higher term premium. So investors are demanding higher yields to compensate for the risk of changing interest rates in the next 30 years. So bonds, investors are not very a big fan of in this environment. And now looking at the January 2027 versus the EFFR Fed Fund spread, we are seeing rate cuts being unwound substantially through the market pricing. So if we look at the end of February, the market has priced in about 60 basis points of cuts compared to the effective Fed funds rates for 2026. That means 2 cuts with a chance of a 3rd cut in the year. Fast forward to today, we are looking at just a chance of 1 cut, really. So not even the 2nd cut being priced in the market. So that shows how much the rates market is being worried about the inflation in the coming month because of the high oil prices. And the Fed is in a bind because usually if you have high inflation, but a very robust labor market, you can keep the rates high or even hike. But if you have high inflation and a weakening labor market, there's not much it could really do to simultaneously reduce inflation and save the labor market at the same time. If you cut rates, inflation could sustain, even if growth or labor market is being saved, and we could see a repeat of the 2021 scenario. So that's what the Fed doesn't want to see. It doesn't want to see the 1970s style hyperinflation and then ultra high interest rates. Unfortunately, there's not a lot the Fed could do in this environment. The onus is not just on the White House, who doesn't like high energy prices but started this war anyway. It's also on Iran coming to the negotiation table and essentially surrendering, or if there's a regime change. So when the war progresses into the 3rd week, at the moment, things are getting quite messy on the ground because Trump doesn't actually have total control without committing ground troops or having naval ships in the area. So it's getting tricky, and obviously no ships are really getting in and out of the Strait of Hormuz. And that scenario, we can't really model. We don't know how long it's going to last, how it's going to end up. And historically, this type of blockade takes more than weeks, if not months, to resolve. Looking at oil prices too, this front-end oil price is very elevated at 95. Back in December, this was in the mid-50s, so we're almost double the price from 2 months ago. And you don't double the price of oil without breaking things for a prolonged period. If you think about not just the raw energy consumption prices, which will feed into inflation, goods input costs will rise as well, and jet fuels prices will rise, and that will have an impact on goods inflation, travel services inflation, and holistic range of inflation data measures that will deter the Fed from cutting rates further. So we really want to see the US having some sort of off-ramp plan to de-escalate and conclude the operation soon and get the Strait of Hormuz reopen, and keep the oil flowing out again. Otherwise, the sustained period of high elevated oil prices could have a very negative shock to not just the markets, but also the real economy. Looking at the volatility, VIX futures, the front end at 26 now, that means the market is expecting an annualized 26% movement in the next month via the options market. It basically means a lot of people are buying a lot of puts here in this environment to hedge the downside risk. And this volatility is not really declining that much further out the curve. So the market is actually thinking about a sustained period of fairly high volatility compared to, the baseline of 16, 17, sub 20 that we saw back in December and January. So this really, we need to see this moving down, even if we see another spike, but it's the down move that will relieve the market stress next. And finally, if we take a look at the macro ETF flows, so what we got here is SPY, IWM, US oil, TLT bonds, IBIT crypto, and GLD gold. And we're seeing in the past 1 week, we're seeing outflow in equities, so SPY and IWM, and that has been true for the past 1 month too, in a much larger degree. And an inflow for US oil, so almost $750 million inflow in the past week, and we're seeing very modest flows in TLT. So there are some inflows in TLT, but it's not regarded as safe haven, and yields have been spiking. So it's really for those who are trying to fade the market move. And IBIT has also gone up, which I talked about to everyone's surprise. It's actually seeing a 1 billion inflow in the past month. And I think that's a sign of a bottoming phase. We're seeing large transaction volumes building for crypto around those price points, and it hasn't tanked given the high yields and high oil prices. So, assets overperforming or consolidating instead of going down in a high pressure environment usually is a bullish sign on the margin. And then we see GLD outflows in the past week, which is quite large, is $500 million. Again, showing institutions are either deleveraging or they're actually now treating GLD more like a risk asset, like the SPY. So the market, as you can see, market dynamics are ever changing. So you can't hold on to assumptions that worked in the previous environment. We have to constantly observe the moving parts. So everyone thought gold is a safe haven. It hasn't performed, but it ran up in the environment where inflation was actually coming down, as you can see in the CPI back in January and February. So, and now inflation, especially moving up, gold is not providing the hedge. So these are the things you really have to be really monitoring very closely over time. Otherwise, you might catch yourself on the wrong side of the trade. So now we are looking at the MOVE index. The MOVE index is the volatility index like VIX for SPY. MOVE is for bonds. It's looking at the market expected volatility for bond prices. And this has been in a very sustained downtrend since the beginning of last year, which is really great for liquidity, because when volatility is reduced, then the collateral value increases for bonds and you can borrow more in the global markets. So that's a good thing. But in the past 2 months, we're seeing a sustained uptick in the MOVE index. So high volatility for bonds. Bond yields have also gone up, which means bond prices have gone down. And that is actually a very big negative for the market. So I'm getting quite concerned here, although I'm not expecting an imminent crash just yet, but I'm definitely watching like a hawk in terms of the market sentiment and the risk appetite. Another thing I would look at is HYG REF ratio. So this ratio is the high yield credit versus risk-free treasury yields, and REF is sort of in not the long end of the treasury, so it doesn't have a lot of duration risk or term premium pricing in it. So this is a fairly clean way of looking at the investor risk sentiment. If the investors' risk appetite is high, they would buy a lot more high yield credit to get the high yields. And if the risk appetite is declining, they will start buying more risk-free assets like treasuries instead of high yield credit. So we are kind of in the middle of the ballpark of the past 1 year range. We're not in the crash zone that we saw in March, April. So that is a positive. But I am wary of this fast decline, which does look very similar to what we had in February last year. And we saw an uptick and then one more crash down. So we haven't got there yet. So it's a little bit premature to panic, but we are really watching to see how this indicator is playing out in the near term to gauge the investor sentiment in a very objective manner. So if it starts moving down again, I will be very, very cautious about a potential larger degree equity sell-off. Looking at the 30-year yield specifically, I think this is a fairly clean 5 waves down going into March, and this was an expected 3 waves up retrace of this down move. So now I don't expect us to break a new high. If we break a new high, we get past 5% because of high oil prices. That's pretty dangerous for US equities, I would say. So I do expect some sort of consolidation and reversal around this point now. I do think this should be a corrective move, and the motive wave is this one, 5 waves down towards the downside of the yields. So my primary bias is towards high bond prices and lower yields. But if we break above this resistance zone, then we really have to stay really on our feet and re-examine the structure. TLT, I think this is a 5 waves up. That's quite clean, followed by 3 waves down. It could test 86, which is the deeper end of this wave C target at the 123% extension of this wave A. I don't expect it to move meaningfully below that to keep this bullish path on track. There's a lot of volume absorbing the prices around this level, so that acts as a natural support as well. If we fall below this, then I think something has really broken the market, and we have to be extremely sensitive and agile in managing our risks. Looking at oil, I think this is a sharp spike in wave 3. We had a wave 4 retrace this week, and we're probably on our way for this wave 5. And this wave 5 can actually hit 140, which was unimaginable only a couple of months ago. So we were trading in the mid-high 60s, and I actually had a bearish outlook given the oversupply of oil globally. But this geopolitical risk actually played out in the worst case scenario, and now oil is traveling wave 3 and 4, and we just really have to stay on our feet to see if we can get this wave 5. Looking at the US dollar, I do think this is a 5 wave up. That's pretty clean. It could stretch to 100.5, but from there, I expect some sort of consolidation and then a retrace in wave 2 for a 1-2 move higher. So the dollar probably has bottomed in Jan. So we are really looking at how the next 5 waves up from here. So looking at SPY, it would seem that the volatility is not actually that high. It's been pretty much range bound since October 2025 when we had a mini correction, and it's just been grinding through this 650 to 700 area. It couldn't break above 700, and then now we're retesting the VWAP from last June. And there is a lot of support in terms of volume around 660. So I do think this region here is probably not that easy to break down. And obviously, the global macro is slightly against and benign equity backdrop. So what I think the base case is, we are probably going to trade between the range of 660 and this high volume node around 690 until we see substantial improvement in oil and yields. But if high oil prices stay let's say for another 2 weeks, then the danger for larger degree downside is pretty much elevated. So base case, I'm neutral. I'm looking for sideways consolidation while the war resolves. But if the war doesn't resolve swiftly, then yeah, I'm definitely getting very concerned for the downside. And also I'm watching liquidity as well as the risk sentiment to see if the crash risk is rising. So I have kept the bullish path here because nothing structurally has broken our bullish expectation. If we can get this war done within the next 2 weeks before the end of March, getting the Strait of Hormuz reopen, then I do think we can rally towards 730, 740 region and have a new all-time high, especially given how well equities have actually held during this period of uncertainty, despite the high VIX readings, which are historically associated with much greater corrections, were really only just 5% down from the all-time high. And that, to me, has been pretty resilient, surprisingly so, in the past few weeks. So QQQ similarly is moving in a very well-defined range between 590 and 635. It couldn't break a new all-time high in January, and it's just been consolidating in a pretty narrow range around 600. The read is very similar for QQQ. So at the moment, it does seem like the mega caps are starting to catch a little bit. So the ones that had fallen before, Microsoft, they are catching a bit more reversal. And the QQQs are no longer a lagging index compared to S&P. So it seems like the broader market has caught up slightly. And what I see here is that we basically just have to watch and be very patient. If we break through this 590 zone, which has seen significant support in the past 5 months since October, then yeah, we have a bigger problem in our hands. We could extend this with a larger degree. This could be a larger degree A, B, and C for this wave 4, and we could be testing 570-ish. But for as long as it stays within this range, we're looking to stay neutral and keep an eye open for the bullish path still. IWM, it has found the trendline support going back from July 2025. We're in quite a heated price region around 250. That used to be the local tops in October, became this flipped into support in December, and again being tested here with high volume nodes. So overall, I don't expect this region to be easily broken. I do think this should be a supportive region, but the chances are with high yields and high oil prices, it could consolidate sideways between 250 and 260 before we get a larger degree bullish reversal. So we just have to be very patient on this. Overall, I don't favor hero dip buying just yet because there's no clarity on how far oil could travel and if yields could spike above 5% in the 30-year. So once we get a much more bullish reversal from those macro factors, then I think we can start thinking about dip buying in this environment. SOXX semis. One concern for semis is that the Strait of Hormuz doesn't just block oil, it's also blocking a lot of raw materials that are key for the chip production. So Qatar is a large producer for some of the key materials, and that couldn't come out of the region to Taiwan and South Korea. That could weigh that could create a supply chain bottleneck for the semiconductor industry, and that could weigh on the earnings for Q1 and potentially Q2. So over here, I'm getting incrementally more neutral. We have held this wave 4 support here, which is great, and we just want to see how the price reacts in the next few sessions, whether it just consolidates, forming a base here before going for wave 5, or if we actually have another retest and break below this, which will change our read of this entire structure. IGV software, it had a pretty good 2-week run, and I do think now it's probably something like a wave 1-2 setup here, looking for a wave 2 retrace. And this wave 2 could retest the 0.618 to 0.786 of this entire wave 1 rally here. But overall, we are seeing large amount of volume being accumulated here with very positive ETF inflows over the past month. That potentially points to a bottoming phase of this move. And what we could really see is also the inverse head and shoulders. So there's left shoulder, the head, retesting wave 2 to form the right shoulder, and then a breakaway in the neckline after to confirm wave 3. Bitcoin is pre-bid in this environment. So consolidating here, given the global macro uncertainties and equities sell-off, is actually a bullish sign on the margin. It's pretty constructive. So I would expect the next target to be around 82K onwards, could stretch to 88 to this high volume region straight away. That would be pretty positive. And I think after that, once we hit this region, there's a lot of people who want to probably offload the bags at break even. Those will try to pick the bottom over here, and we can see a potential retrace drawdown in wave 4 after. So overall, I'm pretty bullish on Bitcoin's reversal in the near term. And of course, if we have a sharp reversal below this wave 2 low, then perhaps this is the wrong read and we have another correction, but that's not my base case yet. ETH has been pretty resilient alongside Bitcoin in the past couple of weeks as well. We are seeing dip buying every time we have a weekend sell-off and the market rallies back during the week. And we are thinking about a wave 3 target around the 2,400 to 2,500 region. That would put us to the 1.38 to the 1.76 extension of this wave 1, which is a very typical move for wave 3. And then we can potentially get a retrace after that. There are a couple of bullish factors for ETH. So ETH is the biggest network for stablecoins. During this crisis, a lot of people have put their money from the fiat in the banking system into stablecoins because there's fewer restrictions. And incrementally, that's great for ETH. And separately, we have the AI agent explosion in the coming month, where people create AI agents to make money for them, to act on their behalf. And agents are not going to use the traditional bank account names. They're going to use on-chain wallets for faster and more scalable transactions. And if there are millions of them, then stable coins and on-chain transactions are the fastest and most scalable way they could work. And that is pretty bullish for something like ETH and Solana in terms of providing the infrastructure for stablecoins. So similarly, Solana has also risen in the past week. I think this wave 3 could test 120, if not 130 region, where there's a high volume profile here. And some people who broke even from buying here could offload the bag, and we see a retest of 100 after in wave 4. For Ripple, that wave 3 target is around the $2 mark. And once we hit this region, we can see some selling pressure and then subsequently a wave 4 decline. Coinbase. So Coinbase hit the 210 mark in wave 3, and now it's consolidating pretty much as expected in this wave 4. I think the next wave higher should target the 240 region. There is a lot of potential resistance around the 240 to 260 from those who bought earlier, expecting a bottom. So that could provide some selling pressure. And we see all 5 waves of this initial rally complete, followed by a wave 2 pullback. Robinhood, unfortunately, Robinhood hasn't been as bullish as other crypto names, but it managed to hold the low of the February 24th. So that is still good. Not quite as strong as, for example, Coinbase or Bitcoin or ETH directly. But I still would expect a wave 3 rally here next that challenges 100. And in this volume zone, we can see some pullback for wave 4. MSTR has surprisingly been more bullish in terms of trend than Bitcoin and ETH. And that shows that early institutional interest is back because MSTR is one of the most traded stocks, both in terms of underlying and in terms of options market. And MSTR has seen plenty of demand for its digital credit product Stretch, which gives you 11% dividend per year. Overall, there seems to be a lot of institutional demand back for MSTR. And of course, MNAV is also rising. So I do think we are on track for this wave 3, and that could test 180 to even 200 before retracing this wave 4, which tests the 160 mark. BMNR has been a bit more sluggish. It couldn't break above this February high just yet. But I think it's a matter of time. If ETH starts going up, which it has, BMNR should follow. So if you're looking at the volume node here compared to the volume node during the November and January consolidation phase, we're seeing a lot of accumulation in this price region. And I don't think this is distribution. That's more like accumulation here. So I think we should get 5 waves up into this 30 mark, and then we could see some people selling from this volume region here. SharpLink has definitely done a bit better than BMNR in this rally, and I think we just want to see a breakout in the next wave higher, which could challenge this volume node here around just under 10. But also it would give us the confirmation that we're breaking above this medium-term price downtrend. Gold. So don't get me wrong. I think the overall chart, if you just look back on how bullish it is still showing pretty strong resilience in the past run-up, even after this high. And we had a big drop at the beginning of February. So we are actually not that much far off the autumn high, and we're way above the 200-day moving average, and we're above the 50-day moving average too. So I can't call this a downtrend at the moment, but what I suspect is that in terms of technicals, this is a quite clear 3 waves up in this wave B. And my concern is that this initial drop was just a wave A. We had a counter trend rally, corrective rally for wave B, and then the next wave should be a wave C lower to finish off this correction. And even if we get to this wave C target, which will have around 420, that's actually not that bad given the overall range. So that would actually just look like it's moving sideways to consolidate and absorb this run up. So overall, I'm neutral on gold, a little cautious that we're looking at a downtrend. But if you just zoom out, it's still quite elevated in terms of the level. So gold minus is a bit more obvious that we are in this large degree wave C, which could finish around mid 80s, and is now kind of coming just off the 50-day moving average. So incrementally in the near term, we're probably looking at a near-term downtrend here with momentum towards the low 80s. And if you look at this bounce, this moved above this initial end of January high. So that's becoming an expanded flat in terms of consolidation in 3 waves. And with minus, it shoots higher on the upside, and then it shoots lower on the downside compared to the underlying asset, which is gold. Looking at silver, the rebound has been pretty sluggish, and I'm worried that we could probably be looking at a wave C correction next. And this wave C correction could test the 200-day moving average around 50. That would put us to the 100% extension of this wave A from the top of wave B. Silver miners, very similar to gold miners, we're looking at a 3-wave corrective rally in this wave B, and now we're looking at wave C that could test around 86 region. Palladium, this is quite obvious, a wave C correction that will probably test the 200-day moving average, if not below, before finishing off. Platinum, the structure is very similar to Palladium, We had 5 waves down in this wave A, 3 waves up in wave B, and now we're looking at potentially 5 waves down again in this wave C that takes us below 145. Copper, overall, I'm actually slightly more bullish on copper than the precious metals. First, fundamentally, we're in the business expansion mode, although I don't know how much of that is left after the oil price shock. But all else equal, we are seeing business expansion, which will demand higher production of copper. And in terms of technicals, we're looking at this 1-2 setup, and then wave 3 high in January, when other charts were probably showing wave 5, and then there's a wave 4 pullback. So my read is that we could get one more high here for this wave 5. And of course, if we breach this low and overlap with the wave 1, we're probably testing the 200-day moving average, and this could be the top. But for now, my bias is towards the upside. Uranium. So uranium, this 5th wave chart is a little bit funny because this is a clear wave 3, but we haven't got the 5th wave yet in this correction. So my read is that we are probably in a expanded ending diagonal where this wave 4 likely overlaps with this wave 1. It hasn't quite yet, but it could. And that will give us a wave 5, one more high here. So here I'm looking at near-term neutral consolidation and then finding support and then one more high in wave 5. BCI. So BCI exceeded my previous expectation. So I thought this could have been in wave B, but this week the market has clearly moved much higher, and that probably shows us to be a wave 5 instead. So wave 5 could extend around to 25. There's not that much room left. So I'm still cautious here. I probably wouldn't chase. Looking at Apple. So Apple, this is now becoming a fairly obvious left shoulder, head, and right shoulder pattern for the head and shoulder pattern, but we haven't quite got to this support line here yet. But I do think we could get there. So the next move is likely lower in this wave 3 of C. That could test the 200-day moving average, and then also this support line going back from October. And after that, we might find some support in wave 4 or bounce, which gets rejected by this high volume node. And then we get one more low that breaks the neckline that completes the head and shoulder pattern. So that sequence is my base expectation for now. And of course, if it shoots straight back up, gets a new high from here, then we will have to re-examine the structure. Amazon, I do think this potentially could have bottomed here. We gap filled last week from this earnings dive, and incrementally things are looking a bit more bullish. However, there is a huge volume profile here with the 200-day and 50-day moving average overhead in this region. So getting past 225 is actually not an easy feat. So we are just having to see how it reacts to this resistance zone. And if we can probably get a pullback in this wave 4 and then one more shot high for wave 5 to complete this initial rally. So, and that would be the perfect start to the reversal. Google, there's not a lot to talk about because this pattern has been forming for the past couple of months. So we're really just seeing if this neckline is going to be broken. And if it gets broken, we're probably going to test 555, where there's 200-day moving average and high volume support here for Google. Meta. So Meta, the chart is actually not that obvious on whether we have bottomed here and this is 5 weeks up, because if this is 5 weeks up, this is the leading diagonal anyway, so the 5th wave is probably not going to be that high. And recently we had a new intraday low below the previous February low, so that's also not a good thing. There is a very high risk that we're seeing what this is to be an ABC pattern within larger degree wave B, so it's corrective and then we're heading much lower. So for now, the market hasn't shown its hand, and we want to just see if we can get past this volume zone and the 200-day moving average to reconfirm we're back on the bullish path. Otherwise, I will stay neutral and probably stay out with this name. Microsoft. So we're seeing an ABC bounce inside this large degree wave A, and I think it hasn't completed yet. It could retest the 50-day moving average at 420. That would put us to the 120% extension of this wave A, and then we can get a large degree ABC rally here for Microsoft. So in terms of valuation, it's also pretty oversold compared to its 3 to 5 year history. So over here, I do think this dip is probably quite playable for a short-term rally. NVDA, there's not a lot to talk about here. It's just consolidating in a pretty tight range between 170 and 200. Incrementally, I lean towards this being a wave C, and we're doing a 1-2 bounce, but still pointing to the downside in the next move. But overall, it's pinned between the 50-day moving average, 200-day moving average, and the high volume profile node around 180. We just need the market to break out for us to confirm which way it leans. Tesla, I mean, there's a chance that given this support has held, we could have stopped here for this wave 5. But truth to be told, this bounce here isn't that strong either. We're still under the 50-day moving average. There's a ton of volume overhead in the 430 region to break through. So a lot of work to do for the bullish positions. So for now, we just have to watch how it reacts. If we break below this line here, we'll probably get to retest 350. And if you look at the volatility curve, it's very much a V shape. There's a heightened volatility expectation for both upside and downside. So the range is pretty wide, and people are paying for both upside surprise and downside protection. And it perhaps signal that there should be a breakout quite imminently. Otherwise, the option seller is just milking money right over here. PLTR. So after reaching the 160 target last week, pretty happy for a retrace in this wave B, which can test 140. It hasn't happened yet. It's still below the 50-day moving average and a high volume node here. So I do think the incremental pressure is slightly on the downside. I just want to see a wave B complete, and then one more wave higher after. Oracle broke out of its downtrend after earnings. Pretty good. It's been rejected at the 50-day moving average, but I really want to see something like a 1, 2, and then wave 3 testing this high volume node around 195, and then wave 4 retrace, and then wave 5 that tests the 200-day moving average if we can get it. APP, I wasn't surprised by this retrace because it ran up quite substantially for this wave A here and got rejected at this 200-day and 50-day moving average intercept. So I think wave B can test 410 and even deeper at 385 where there's a lot of volume. And then after that, we can get one more rally in wave C. CrowdStrike. So I was a little concerned that this could be a fake breakout like this time here in January, but it managed to move above the 50-day moving average, which it didn't in January. So that's good. And afterwards, I think if we can retest the 200-day and then retest this trend line resistance in wave 2, that is pretty bullish. And we can look at 5 waves up from here. I believe cybersecurity is extremely important going forward. So the likes of CrowdStrike and Zscaler will outperform the market. From the perspective of geopolitical uncertainty, a lot of the war is conducted via cyber rather than on the ground. So extremely important to own cybersecurity names. And if we have the AI agents outbreak, again, you need heightened security because the attack surface has suddenly expanded with really smart bots attacking using AI. Cloudflare, this move here has invalidated my previously bearish thesis. So I think this is probably first corrective wave. I want to see how far this carries on and how the next retest goes. It might retest this trend line here before moving higher. Broadcom rallied off its earnings, pretty good. Moved above 50-day moving average, also pretty good. So there's a chance that we finish our wave C here after the gap fill. And it really depends on if we can just get a bit more juice out of this rally, moving above this wave B high, and then potentially we're looking at the next impulsive wave. ASML, overall, I do think the near term is probably in a downtrend, and this is like a small degree shoulders head and the right shoulder pattern here. So overall, I'm probably a bit more cautious here in terms of valuation. It's also trading at its 3-year high. And I don't really see a case of chasing the name per se just yet. ARM Holdings. So this wave 2 expectation has played out pretty perfectly. It's retested this 0.786 retrace of this wave 1. So I think we are looking at potentially the next wave being wave 3, and then all 5 waves attacking the upper end of this channel. AMD, I think there's a chance that we completed all 5 waves of this wave C, of this large degree wave 2. And we are looking at these 5 waves here, even though the 5th wave is a little bit short, but we could deem it complete here if we can get a more sustained rally above the 50-day moving average around and above this high volume node here. So for now, I'm still neutral. I want to see the initial bounce. If we can get above 220, and I think that's case closed for this being wave C, and we're looking at the next impulsive structure. So that's it for today. Thank you for tuning in, and we'll speak next week.